And so this is interesting and depressing. So if you have worked before, you know how much tax is taken out of your paycheck. And if you haven't worked before, once you get a job after you're done with these classes, you're going to find out how much tax is. You're going to find that a substantial amount of your paycheck goes to the government. Um, it might be for good reasons. It might be for social benefits, but still, it's not fun to get money taken away. And there's an employee portion of that and an employer portion of those taxes. And so you're not even seeing the full hit of the taxes. If you're an employee, the employer also owes taxes. And so employers incur expenses and liabilities from having employees. So if you hire an employee, you don't just hire that employee and have to pay their salary. You also have to pay additional taxes on top of that. And so there's all of these different taxes. And this is why I'm not a fan of tax law. I think I'd be too depressed. But you make your gross pay, and then there's minus deductions. You have federal income tax, state and local income tax. You might have voluntary deductions, like I might donate to a church or a religious institution or a nonprofit. We have our Medicare taxes and our Social Security taxes, about 7%. And then we receive our net pay. Then the employer also has taxes. These FICA taxes are what the employer also helps pay. So the employee FICA taxes are Social Security and Medicare. So out of every paycheck, 6.2% of the first $118,000 earned in 2016, it's closer to like $140,000 now, all go to your Social Security, which is in essence an idea is like it's a pension where if you've worked for 30 years, once you hit the age of 60, or 65, you can get a set amount of payment for the rest of your life. So it's a buy into a government pension. And then 1.45% of your income goes to Medicare, which is similar to Social Security, where the concept is once you hit a certain age, you'll always have a basic level of health insurance. And so it's a kind of government-sponsored health insurance plan. So it's a way to protect ourselves when we're older, because many people weren't saving for their future, and when they got old, they weren't able to work, and then it led to poverty for the elderly. And so this was a program to mitigate that, to take care of the elderly. So we withhold this to the IRS every year. So instantly 7.65%. So almost 10% of your check just disappears. And it goes to these programs, which you'll get back when you're 60, 65 or older. So that's the employee FICA taxes, but we then also have incremental taxes on top of it. We have employee income tax. So you have federal income tax and state and local income taxes. You'll find California's state and local income taxes. So California and San Jose has rather high state and local income taxes. And so these amounts are withheld on top of the employee FICA taxes. And you don't necessarily see any long-term benefits from these. These aren't withheld in a big fund for you to get money back in the future. These are for social programs. So it might be for your roads, it might be for your pipes, it might be for your paying for the police department or public hospitals. So this amount depends on the employee's earnings, and tax law gets rather complex, but we're in a bracketed system where as you earn more, the new buckets that you earn in, you pay new amounts of taxes, but you don't pay that higher rate on the earlier tax buckets. And so we must pay taxes withheld from employees' gross pay to appropriate government agencies. So we have to, every paycheck, you withhold some kind of money, and that gets sent to the government. And then we file our tax returns at the end of the year, which says if the money withheld was correct, if they withheld the correct amount. And there might be voluntary deductions as well. So this might be union dues, savings accounts, 401k, pension contributions, insurance, like if you get insurance through your company, and charities. And then employers might match these amounts. Like at Google, they match a certain amount for the 401k. And so all of this has to be recorded. So you could become an employee payroll expert. The payroll is a whole area of accounting where you could go and do it for companies, and they need someone who understands that. So it is a little complex, but it's really just a mathematical exercise. So you can see here from a company perspective, let's say we have a person, let's say we give Christina $2,000 every 2 weeks. So it's not a bad salary, right? That's like $60,000 a year probably, or close to it. So $2,000 every 2 weeks. Well, we have to record 6.2% of that is going to go to Social Security. 1.45 goes to Medicare. Then we have the federal income tax based on withholding amounts, all these withholding amounts. The percentage will be given to you to calculate, to know how to do the calculation. I won't ask you to know the laws. And then after all these deductions, this is the net pay. So that net pay is what you would get in your paycheck, or Christina would get in her paycheck. And so she has a $2,000 salary, but she's going to get a $1,524 paycheck. And so $500 goes away. So that's where the not fun part is for the employee. There's also an employer portion, which we're going to go into as well. I'm not asking you to memorize any rates here. You'll be given it. Just know if I ask you to calculate an employee's pay, or if I ask you to calculate the journal entry for a salaries expense, you have your debit, your salaries expense, and then you have to credit all of these liabilities. All of these are liabilities. And then once every quarter, we'd go and remit those liabilities to the proper institutions, or for the salaries payable whenever we pay the salaries. So there's many liabilities on the book, all under really what we consider a salaries expense. So how do we record the employer payroll deductions? All employers worry about are FICA and Medicare taxes. And there's some federal unemployment taxes or state unemployment taxes they might have to worry about, but we're not really going to go into a ton of detail on that. I care more about the FICA and Medicare. So the federal unemployment tax and the state unemployment tax, you don't have to memorize these rates. I'm not going to test you. But the idea here is they have to pay a certain percentage amount of additional taxes for all employees based on just so if an employee gets unemployed, like we saw a lot of in COVID-19, that the state can pay out unemployment benefits. So they'll give you you can always use the percentages, and I'll let you use the percentages for your exam, so you don't have to memorize them. But in addition to the payroll, the $2,000 in payroll expense that the company has, she'll have to add on another $273 because you take the 2,000 times all these new rates. So you just kind of go down all the different taxes. 2,000 times the 6.2%, 2,000 times the 1.45% gives you the 29. 2,000 times the 5.4 gives you the 108, and the 2,000 times the 6% in the last slide gives you the 12. And so in actuality, right, the taxes here are really $2,273, and the employee is getting $1,524. And so that's where taxes get rather, in theory, the company could be paying this person $2,234 if they didn't have to pay all these taxes. And so that's where you get a lot of interesting debates. I'm not here to say what's right or wrong of does government taxation actually encourage employment, or could it discourage employment, because then why hire so many employees if they're going to be so expensive? Or could it actually, if people actually have the money instead of the government programs, could they be helped? You can see all of that from kind of these journal entries and understanding the tax law of how heavy the tax burden can be to companies. And so that's also where you might hear companies say, well, we don't pay income tax, but we pay taxes. They might be saying, well, we pay these employee taxes. Many companies, you always have to pay the employee taxes. They don't get away with that, but they might not be paying a company income tax. So now we're getting more sophisticated as accountants. We can discern and understand where much of the public dialogue might be. It might be somewhat correct, but we need to, there's truth underlying both arguments. And that's where we want to be. We want to be critical thinking as college students and as future professionals. So those are the calculations. I'm not going to go into a lot of detail. It's just straight math, right? You're going to get a number and you just have to prorate it. And then you have all your liabilities, and then you just have your salary number. And that's all it is. Just make sure you know how to classify all that out and to multiply it by the liabilities. And remember, there's an employer and an employee portion of it. So what are some internal controls for payroll? So this was pretty complex, right? This kind of doesn't look fun that you have to think about. Some companies have hundreds of thousands of employees, and you have to get all of these numbers right, and you have to have the systems to support it, and then you have to make sure all those payments are going to all the governments that the right governments, each state and federal government, maybe not just in the US, but globally, it can be a rather daunting job, right? And so we have to have strong internal controls. This reminds me of a time when I was an auditor, right? I was auditing a startup, a very successful startup that got acquired for hundreds of millions of dollars. And when I went in, and they only had a few hundred employees. And so they didn't have strong internal controls. And so I had to go in and check their internal controls and figure out if they were doing their payroll expense correctly. And then the first thing I did was check out their hiring process, right? Their hiring process. How did they interview and hire employees? And I made sure that this hiring process was separate from the payroll process. Like, hey, if I could refer someone, let's say I refer one of my students, let's say Michelle, I ask her to come work at my company, or Benjamin, and I hire them, and they're a friend or they're a student, and I then could choose their payroll. And so let's say I hire them and maybe it's not my company, maybe it's another person's company. I could hire them and give them a higher salary, and then we could work out something together and say, hey, I'm going to give you a $200,000 a year salary, but you got to give me $10,000 back, right? I can commit some kind of fraud or deception because these processes aren't separate. If your hiring process and payroll preparation processes are combined, you can collude. So we have to keep them separate. And then the payroll between the timekeeping has to be separate, right? Like if I'm in a payroll department, but I also control the time cards. So let's say Ben comes in and he punches in 40 hours, but he doesn't get to choose the final amount of hours. It's the payroll department. The payroll department could put in 50 hours and then take 10 of those hours and funnel it to themselves. And then the payment, if we don't keep this separate, that whoever's doing the payment could increase the payment amount and then bring it to themselves if they can control either the timekeeping, the hiring, or the payroll. So we need to keep all of these separate. So when I was an auditor, I came in and I actually found these situations where maybe hiring and pay were completely combined. And you'd find managers who would hire friends and then give them extremely high salaries because there was no controls around it. And so I'd have to come in and present to the owners of that large company, like, hey, this is a huge risk and you might need to lay off some people, right? So this is or you at least need to discipline your managers and correct the payments. I remember I saw one guy once who came in, he had an associate's degree. He came in at $40,000 a year. And within 2 years, he was making $400,000 a year. And so he had no qualifications and he wasn't doing anything beneficial for the company. So you can see how this could be very, very important for a business if it's not being ran correctly. Let's talk about multi-period known liabilities. Includes unearned revenue and notes payable. So unearned revenue from magazine subscriptions. Let's see, unearned revenue. They cover more than one accounting period. So all we're saying here is we can sometimes have deferred revenue or notes payable that go greater than 1 year, right? We might have a 3-year notes payable. We might have a 30-year notes payable. We might have deferred revenue. Like you could pay me for accounting services and you could pay me for the next 10 years. You could pay me upfront for 10 years of services, right? When we have that, just know that it exists and that we'd have to recognize revenue over those periods, but also the amount that's within the next year would be classified as short-term, and the amount greater than a year would be long-term. So if I had 3 years of deferred revenue, the first year would be considered, let's say $3,000 equally. $1,000 would be short-term, $2,000 would be long-term. And then, so this is just the calculations. I'm not going to go through these. It's self-explanatory. You just have to know all the different lines and you have to go through the calculations, which will be given to you. So there's nothing special here. It's just prorating the dollar amounts.